is not participating in the rally. We do have the bonds that are picking up the baton, and the 10-year bond prices have actually touched a fresh 32-month high, taking the yields to as low at 6.74% in today's rally in the bond market. And this is based on expectations that the RBI will turn dovish in the October policy. Latha is joining you with us to give us more on this update. Today, bonds is something that is, that everyone is watching out for as well. Equity market's not exciting.
Yes, 32-month highs on bond prices, which means yields, which move in the opposite direction, are at 32-month lows, 6.74. And this is largely because the policy which comes on October 9th from the Reserve Bank is expected to be dovish. Now, why are people penciling in this increasing, why are they getting this increasing confidence that the Reserve Bank will turn dovish? One, because the rains and the La Nina effect that is expected, continued rains is expected to engender a softer regime of food prices. That has been the only sore point in the inflation numbers, food inflation. Core inflation has been falling for the past 10 months. For the past 10 months, it's below 4%. 4% is where the MPC is mandated to keep CPI. Of that, core CPI is below 4 for 10 months. And the crude price, as we know, last few weeks has been falling to around the $70 to $75 mark. The fact that the US Fed has cut more than expected, leading to the PBOC cutting more than expected, has led to a global fall in yields. And that is abetting the fall in yields in India as well. An important, but maybe, not immediately important point, there is a gentleman called Nick Timiraos. He is kind of the Fed's mole in the market. He writes for the WSJ. And it was he who first signaled that it might be a 50 basis cut even in the September policy by the Fed. The market was penciling in 25. Now, Timiraos has tweeted that in the conference board data that recently came out, the difference between plentiful jobs and hard-to-get jobs is declining. That usually means the labor market is not offering too many jobs, which is being read by some in the market as a sign that November also could be a 50 basis cut by the Fed. Of course, that's a far cry. But what I'm telling you is that there are so many factors that are adding to dovishness in the Indian market as well. And last but not the least, the government is going to announce the second half borrowing calendar. It borrows via bonds. That calendar is going to be announced tomorrow. Because the first half ends on September 30th, obviously. That amount is likely to be about 6.3 lakh crore if you just do the arithmetic from the budgeted estimate minus first half borrowing. But there is a small feeling that it could be even lower than expected, simply because the government didn't spend too much in the first half. Taxes have been better than expected. So all this is leading to the fall in the bond yields and the rise in bond prices. But the dominant feeling is RBI's. People are not going to the extent of saying that they will change the stance to neutral, but they're definitely expected to sound dovish.
All eyes on the Reserve Bank of India then on the 9th of October. Latha, thanks a lot for that explainer. But